Welcome to the Northbound Wealth Podcast. All opinions expressed by Brent, his co-host, or his guests are solely his own opinions and do not reflect the opinions of Northbound Wealth Management LLC. This podcast is for informational and educational purposes only and is not intended as personalized recommendations or fiduciary advice. It is not intended to provide and should not be relied upon for any investment, accounting, legal, or tax advice, or as a solicitation to offer or to buy any securities. Clients of Northbound Wealth Management LLC may maintain positions in the securities discussed in this podcast.
Hello, everyone, and welcome to summer, June 29th, Weekly Market Insights, the Northbound Wealth Podcast. Your host, Brent Foster. Tech steps back, banks, healthcare, and industrials step forward. That's the headline. Stocks ended mixed as falling oil prices helped lift the Dow Industrials, while concerns about AI valuation put pressure on the broader market. The S&P 500 fell 1.95% last week, closing Friday's session at 7,354.02. During a week that U.S. President Donald Trump said Iran violated the country's ceasefire agreement, the NASDAQ Composite Index skidded 4.60%, closing Friday's session at 25,927.62. The Dow Jones Industrial Average rose 0.60%, closing last week at 51,876.11. The MSCI EFA Index, which tracks developed overseas stock markets, lost 1.33%. To start the week, this is Monday, June 29th, and the markets are up quite reasonably today. So making a bid back up, not in the red, but in the green. The S&P 500, with just 2 trading sessions remaining in the month, the market benchmark is down 3% for June, but up 7.4% for the year. From a technical perspective, the bull market is still intact across major indexes, with consolidations or corrections as normal aspects of market performance. U.S. stocks gained last week on a memorandum of understanding targeting a permanent peace deal to end the war between the U.S. and Iran. The agreement included reopening the Strait of Hormuz, a key choke point for crude flows. However, U.S. President Donald Trump said on Friday that Iran shot at least 4 one-way attack drones at ships crossing the Strait of Hormuz on Thursday. The attack was, quote, a foolish violation of our ceasefire agreement, end quote, Trump said. Questions swirling around the sustainability of the artificial intelligence boom also weighed. The week's drop in the S&P 500 came on declines in only 4 of the index's 11 sectors. Communication services fell 6.2%, technology shed 5.4%, consumer discretionary slipped 2.7%, and materials declined 0.1%. Google parent Alphabet was one of the hardest hit stocks in communication services this past week, falling more than 8%. A Bloomberg report said that the company is poised to lose 2 leading AI researchers to Anthropic. In technology, ON Semiconductor, ticker symbol ON, had the largest percentage drop of the week, sliding 25%. The chipmaker agreed to acquire semiconductor company Synopsys in a deal with an enterprise value of about $7 billion. Aiming to expand into physical artificial intelligence in data centers. In consumer discretionary, Nike shares led the drop, falling 9.9% amid downbeat analyst reports after the company named a new chief financial officer and said that excluding a one-time benefit, it expects fourth quarter results to be generally in line with previously provided guidance. Analysts at Evercore ISI and KeyBank downgraded their investment ratings on Nike stock, with multiple other analysts reduced price targets on the shares. On the upside, healthcare climbed 7.9%, followed by a 4% gain in real estate, a 3.9% advance in utilities, and a 1.5% increase in consumer staples. Energy, financials, and industrials also edged higher last week. Biotechny led the gainers in healthcare, jumping 23% on the week as the company said it agreed to be acquired by Merck in an all-cash deal with an enterprise value of about $11.3 billion. Merck will pay $73 per Biotechny share in cash, which the company noted represents about a 36% premium to the U.S.-based company's one-month volume-weighted average trading price. Next week's economic data will feature the government's June employment report due Thursday. The U.S. stock market will be closed on Friday in observance of Independence Day. So the inflation update is the Fed's preferred measure on inflation, or PCE, or the Personal Consumption Expenditures Index, came in as expected for May, while the core number, which excludes energy, was at its highest level since October of 2023. However, investors appeared relieved that there were no new surprises, especially from the new Fed chair, Kevin Warsh. So, in review, the Dow year to date trailing is up 8.91%, MSCI EFA index 9.59%, S&P 500 up about 8.11%, Nasdaq Composite is up about 9.44% as of last week's close. 10-year Treasury note 4.38, that's down from 4.5 just a month ago, which is a good news. All right, Tuesday, S&P Case-Shiller Home Price Index, Chicago Business Barometer, Consumer Confidence, Job Openings, Labor, Turnover, or the JOLTS report. Wednesday, ADP Employment Report, Purchasing Managers Index. For manufacturing, Institute for Supply Chain Management and Manufacturing and Construction Spending, that's on Wednesday. Thursday, Employment Report, Weekly Jobless Claims, Factory Orders. So we'll be tracking the key economic data for you. We've got Tuesday, Nike reporting earnings. Wednesday, General Mills. Those are the notable companies. That is what we got for you on the market insights and market update, and we're going to stay tuned for the next segment. Hey everyone, I thought this was really interesting. I went out to Investopedia. It's a great resource for personal finance topics. If you have anything they have questions about, they do a great job compiling information, and I like it as a resource. So check it out, investopedia.com. But I typed into their AI tool, what are the top personal financial topics of today? I pretty much know what they are, but I just thought I'd share them with you. And it's interesting to see the reveal based on their AI tool that's searching all of their information and all their information that a lot of financial professionals use, as well as personal financial people, everyday Americans. But the top key takeaways is inflation and rising living costs are a top financial concern for Americans in 2026. Retirement readiness and IRA usage remain central personal financial discussions. Housing affordability and delayed life milestones are reshaping financial planning. Debt, budget, stress, and financial anxiety are growing issues. Prenups and financial planning within marriage are becoming more mainstream. And this is based on the most recent coverage in Investopedia's library, June 2026. The top personal financial topics right now center on inflation, retirement, housing affordability, debt, stress, and financial planning before marriage. So, number one, inflation and financial anxiety. As of June 3rd, 2026, inflation is still viewed as a major financial threat. In why 26% of Americans are spending beyond their means as financial pressures mount, Americans reported mounting strain. Nearly 2/3 called inflation the biggest threat to their finances in 2025, and 44% said it remains the largest obstacle to their financial security. The same report found that 52% believe inflation is rising faster than income, and 69% said financial worries have made them anxious or depressed. Managing everyday costs, groceries, housing, fuel is a dominant personal financial theme or finance theme in 2026. Number two, retirement savings and Roth IRAs, June 10th, 2026. Retirement planning continues to be one of the most talked about personal financial subjects. And how many people have Roth IRAs? Different data sets paint contrasting pictures. June 10th, 2026, the article notes Roth IRAs are one of the most talked about retirement tools, often promoted for their tax advantages and long-term flexibility. Traditional IRAs remain more common, but Roth IRAs attract more active contributors, especially young savers. Discussions around retirement readiness, tax strategy, contribution rates, and whether Roth or traditional is better are major current focus areas. At the same time, retirement confidence is slipping. In late June 2026, Americans said they now need $1.46 million to retire comfortably, and nearly half don't expect to be ready. Retirement adequacy is clearly a top concern in today's environment. Number 3, housing affordability and middle class milestones. This is an article June 22nd, 2026. A major trend in 2026 is the rising cost of traditional milestones like owning a home. In Why Traditional Middle Class Milestones Are No Longer Affordable for Many Americans, the article highlights rising costs, stagnant wages, and geography all determine whether big life milestones feel within reach. Owning a home remains a top goal. 22% call it their most important milestone, yet 1 in 4 report delaying it due to financial pressure. Housing affordability is one of the most persistent conversations in personal finance right now. Number 4, debt levels and managing spending. Debt management remains front and center. Household debt continues to climb, including credit cards, mortgages, auto debt, and student loans. Investopedia defines personal finance as covering key areas like income, saving, spending, investing, and protection. With credit protection, it, by the way, means insurance. With credit card balances rising and emergency savings strained, budgeting, paying down debt, and avoiding lifestyle creep are recurring themes across coverage. Number 5, prenups and financial planning before marriage. So June 23rd, 2026, they're pulling from an article. A newer but increasingly visible topic is prenuptial agreements. And prenups have become more popular. Do you need one? The article explains taboos surrounding prenuptial agreements have lessened in recent years, and millennials and Gen Zers have a growing enthusiasm for prenups. The share of couples signing prenups rose 3% in 2010 to 15% in 2022. Conversations around asset protection, later in life marriage, and financial transparency before marriage are gaining attention, especially among younger adults. What people are focusing on most in 2026? Putting it all together, today's top personal finance topics are, again, inflation and cost of living pressures, retirement readiness and Roth IRAs, home ownership affordability, debt stress and budgeting discipline, financial planning within relationships or prenups. If you'd like to go deeper, it might help to explore some of these topics with a financial professional like myself, Brent Foster, Northbound Wealth Management. You can reach out to Northbound Wealth Management and our team at 317-399-1107. We look forward to talking with you and working through some of the questions you may have to help you on your journey in life. I hope you guys have a great 4th of July and holiday weekend. Enjoy the summer heat and time with friends and family at the lake, grilling out in the backyard. There was an article in the Wall Street Journal written by Jason Zweig that I really like. How to build a retirement that actually fits your life. Ending up with the right amount of money is less about the stock market and more about you. June 26th, 2026. The stock market will provide, the article starts out. That seems to be the mantra of millions of people saving for retirement, and with stocks near record highs after several stumbles this year, you might feel the same way. You shouldn't. The market doesn't always provide. To fund a sustainable retirement, you will have to provide. Most advice on this topic is backwards, says Edward McQuarrie and William Bernstein, authors of a book that will be published next March in 2027. Retirement, How to Save Enough, Invest It Well, and Make Your Money Last. And that's the title of their book. Forget about savings rates and spending rules for a moment. Just pause button on those. To reach your goal, you will have to know who you are and where you want to end up. Do you hate to spend? Are you afraid of dying broke? Are you comfortable with the thought of ending up the richest person in the graveyard? Then you should underspend without any shame. On the other hand, does saving for tomorrow feel like a deprivation today? If you have less assets left over at the end of your days, would you feel that you missed out on living life to the fullest? Then you're going to need everything to go your way, says McQuarrie and Bernstein. So Macquarie is an emeritus business professor at Santa Clara University who has studied the returns on stocks and bonds back to the 18th century. Bernstein is a neurologist, investment advisor, and financial historian. Both are retired, but their message is relevant for young investors, pre-retirees, and retirees alike. First, your future investment performance might not match what you'd expect from the past. The average 30-year return on U.S. stocks since the beginning of 1793 is about 6.2%. That's the real return, net of inflation. That's an average, not a guarantee. Over the 30 years ended early 1995, the annualized real return on stocks was only 4.3%. And across all 30-year periods, stocks have produced a real return of less than 4% annually, about an eighth of the time, according to Macquarie. Second, your spending needs in retirement aren't reliably predictable. Your good health might turn chronically bad. Your money pit of a house might morph into a black hole. Your successful children might boomerang back into your basement. Finally, you don't know how long your retirement will last. You could live to 120 or get hit by a bus tomorrow. If you live longer than you expect, then you could run out of money if you haven't saved enough. And by enough, says Macquarie and Bernstein, is probably way more than you think. I asked them if there's a ratio of assets to spending that maximizes the odds of a secure retirement, even if stock returns stink or you turn out to be Methuselah. If your investment portfolio is 50 times your annual spending, you can stop worrying about whether you'll run out of money, they both said. That means $1 million is plenty if you can live on $20,000 a year. If you spend $200,000 a year, you'll need $10 million. Cut your spending and your required savings will go down as well. Meeting your goals takes a mix of discipline and luck. You can make it if you start young and take advantage of events. It's easier to avoid raising your average spending in the first place than to cut it later. People adapt to spending. It becomes a habit that's hard to break. Don't let keeping up with the Joneses become a Jones in itself. BMWs, fancy clothes, and Birkin bags aren't lifestyle choices, says Bernstein. They're IQ tests. When you get a raise, a bonus, an inheritance, or a windfall, keep your spending constant. Invest your newfound surplus in low-cost market tracking index funds or diversified target date or retirement funds or diversified portfolios. Continuing to live as you did before, even as your means take a jump upward, is the best way to turbocharge a program of retirement savings, writes Macquarie and Bernstein. For younger people, your goal should be to save at least 20% of your earnings every year of your working life. And I agree with that. That's a good number. That big number demands a lot of discipline, though. You'll also need luck, the good fortune of getting several decades of robust market returns. Short of that, seek another kind of luck, finding your dream job. I agree with that too. It's better to work at 80% of your optimal salary at a job that you love than working at a higher paying job that you hate, says Bernstein. You're not going to get much less in Social Security out of it, and you can work and save until you're 70 instead of burning out and having to retire because of your psychiatric bills at age 55. People closer to or in retirement have to think harder about making their money last, says Macquarie and Bernstein. If what worries you is dying broke, you shouldn't look to live within your means. Live beneath them, says Macquarie and Bernstein. Don't let a financial planner lock you into withdrawing a fixed percentage of your assets each year to fund your retirement. Cutting your spending is the ultimate way to retain flexibility. And I repeat that. Cutting your spending, making sure you're watching your budget. What if you want to use your retirement to live it up and catch up on all the fun you missed out on when you were working stiff? Then, warns Macquarie, your goal shouldn't be to come as close as possible to bouncing the check to the undertaker, end quote. If you live longer than you expect, he says, or markets return less than you expect, you'll end up bouncing all your checks. And that's not worth it. The two authors' advice might seem obvious, But if so, why are so many savers on a trajectory that will fall well short of funding a secure retirement? For investors of all ages, a stock market near record highs should be a reminder that while the good times can roll, they can also roll away. All right, I thought that was a great article by Jason Zweig, and I'll be looking forward to reading up on Macquarie and Bernstein's new book next March of 27. I hope you like this segment. Stay tuned for the next one. This 4th of July is a milestone year. It's our nation's 250th birthday. While you're out enjoying a barbecue with friends and family, here's a fun story to tell everyone about our oldest founding father, Ben Franklin. When he died in 1790, he left the cities of Boston and Philadelphia with roughly 1,000 pounds each. For the first 100 years after his death, half of the proceeds were used to make low-interest loans to tradesmen. The rest had to remain for another 100 years. When the money came due, 200 years after his death, Philadelphia had $2 million and Boston had $5 million. Remember that money is of a prolific generating nature. Money can beget money, and its offspring can beget more, and so on. 5 shillings turned is 6. Turned again, it is 7 and 3 pence, and so on, till it becomes 100 pounds. The more there is of it, the more it produces everything turning, so that the profits rise quicker and quicker, wrote Franklin in his 1748 essay, Advice to a Young Tradesman. Have a wonderful 4th. Happy birthday, America. Here's to many more.
Whether you're just getting started as an investor or you're managing a multi-million-dollar portfolio, Northbound Wealth Management has the solution for you. It all starts with building the right financial plan. To speak with a financial planner today, visit northboundwealth.com. Don't forget to check us out on youtube.com at Northbound Wealth. And make sure to leave a rating and review on your favorite podcasting app. Thank you for listening.